Hope you're fully caffeinated. We're really excited about the next panel, and I'm really delighted to introduce Leslie Picker of CNBC. And this whole panel is about the very end of cash. Take it away.
Excellent. It is on. Excellent. Hi, everybody. Thanks for joining me. I'll start by introducing my fellow panelist with David Ronick to my left. He is the former CEO of Stash and a serial entrepreneur. We also have Prashant Gandhi, who is a managing director and head of digital payments for JP Morgan. Next to him, James Anderson. He's the executive vice president for digital payments products at MasterCard. And last but not least is Sharad Shada. He's the co-founder and governing council member of iSpirit Foundation. So first of all, I just want to kick things off with an unscientific survey. Since the title of this panel is The End of Cash, I'm curious, how many people here carry a checkbook on a daily basis? Just raise your hand.
1, 2.
I'm looking for hands. I'm not seeing many. How about cash? How many people carry cash every single day with them? A few more hands. Okay, so that's a pretty decent amount of people. A recent study from the Federal Reserve Bank of San Francisco showed that in 2015, this was published about a year ago, but in 2015, cash still remained the most popular method for retail transactions, used about a third of the time. That was followed by debit cards, and then credit cards, and then electronic methods of payment. But if you compared those figures to 2012, the proportion of cash shrunk from 40% just in that amount of time, just in those 3 years. And electronic took more share, from 7% in 2012 to 11% in 2015. Now, I want to just kick things off and hear from each and every one of you about how you see the share of electronic payments and cash payments changing over the next 3 years. Starting with you, David.
Okay, thanks. So, I mentioned when we were getting to know each other that my experience has been fairly narrow in terms of building a venture that is digital, and it's about helping millennials start to invest. And so I don't have the breadth of knowledge on the industry that a lot of others do. But in doing the research on this thing, and we got 1.2 million people to open brokerage accounts on their phones in 2 years, in the last 2 years. And in doing the research, we kept hearing, what's your expectation in terms of experience? And it was so common to hear people say, I want an experience like Venmo. It was like, and it was early for Venmo a couple years back. And I think when you start to see that, and I have little kids, and start to see how they think and what their expectations are, I just think when my kids grow up, there's not going to be cash. They're not going to know what cash is. I want to save some to show them. It feels like to me, it's going to happen like very, very quickly, and I think it needs to.
You can open up the cash museum then. How about you, Prashant? What do you think about the proportion of how people are going to spend money in the future?
Leslie, can I just maybe build on your crowdsourcing?
Yeah,
and maybe
absolutely.
Ask the group 2 questions. So you asked the group, how many of you are carrying cash? I'm going to ask you 2 follow-up questions. First is, how many of you, those who raised your hands, are carrying cash to pay another person? To pay a friend, to pay a family member? How many of you are actually carrying for that purpose? How many of you are carrying cash to pay to a small business, a merchant, a food truck? And how many of you are carrying cash to maybe take it to a large company and maybe go to a store like Gap? Anyone? So I believe that, I was going to say that, so in US, just to maybe back up, and I'm sure James is going to talk more about your question, Leslie. If your question is anchored around US, I'd say that change in US will take time, because we are at a different place in our evolution than some of the emerging markets, and folks like MasterCard are doing an amazing job in transforming economies in the emerging markets. But in US, where roughly speaking 45% of transactions today are electronic and the rest is cash, I'd say another, you asked 3 years, I think if you can move the dial by another 5 points, that'd be amazing. But we're talking significant numbers. So I work at JP Morgan Chase. If you guys haven't heard of Zelle, I suggest you please Google Zelle. Zelle is a consortium of 30 banks, which is ensuring that you can move money to 86 million people by the end of the year, real time, meaning your friend would have money right away. So this is new. Zelle has just recently launched, and I believe Zelle will be a fairly large catalyst for us to move to a cashless economy. And I would say the second reason why I'd say we'll have an accelerated move to a cashless economy is a lot of you raised your hands on food truck and all that, so paying small businesses. There is a real revolution out there on the acquisition side of the business, and institutions like Square and others are really doing an amazing job in making it easy for small businesses to accept other debit and credit cards. So I also see that changing. So long answer to your short question.
Okay, so we used to actually talk internally about fighting the war on cash, and it was sort of a bit of a mantra we had. But in reality, it's all about delivering a better consumer experience and driving people to shift based on the value that we can deliver in their lives. And if you look at what we've been able to do over the last 50 plus years, it's move a huge amount of money from cash and check onto plastic. That was a long-term revolution, and it's spreading around the world and continues to grow about 8 to 10% a year. And the numbers are already big, so 8 to 10% growth on that is a pretty big number. And then in the last 10 years, what we've been doing, so that's enabled us to create a very big network, which connects 2 billion cards with about 40 million merchants. And then the last 10 years, we've been figuring out how to take the power of that network and deliver it onto these devices, any kind of general purpose computing device. So in cards, we created a bespoke device that we gave to our consumers, and we had bespoke acceptance on the merchant side. And that took us so far. But there are intrinsic limits to that. That device, that card, is really, really good for making payments. It's not really, really good for making phone calls, browsing the web, playing with apps. That's why you have one of these. And so what we've been doing the last 10 years is kind of bringing those two powerful capabilities, the capabilities of a device and the capabilities of our network together to deliver better user experiences. And I think that's what's going to drive the continued conversion away from cash onto electronic payments, whether it's on a card, on a device, whichever works better for the consumer and for the use case. A good example, Zelle is something that could never work from a card because you can't type in somebody's email address into the card and send money. But if you connect that front end to the network, we have something called MasterCard Send. You have a front end that could live on the device, any device, and can actually push money through the network. So I think that's kind of a next wave for us. It's a wave that we've been talking about for a while, but I think we're at the point of we're definitely at the point of seeing the inflection in terms of growth.
I would give you an India perspective because I've been back in India now for 12, 13 years. And there are a bunch of things that are happening in India which collectively are called India Stack. And last year, one of those layers of India Stack is a payments layer. It's called Unified Payment Interface. It's growing at 100% year on year, month on month actually, and it's doing about 79 million transactions a month. Just last month, we expect to do 150 million. The next month, and so on and so forth. Our expectation is that it will carry more money relative to the economy than MasterCard carries in the US in less than 3 years. Now, why is that happening? Because in India, the driver for use of digital cash is actually data. The small businesses don't get any credit. And for them to be able to get credit, they need to show what their income is. The only way to show their income is to be able to collect money using digital cash. And the human behavior is, our consumer behavior is that if you go to the food truck and that person says, hey, can you give me digital cash? You'll give digital cash, right? Yeah. And so this is not driven by consumers, it's driven by merchants. And now I am not a financial guy. I'm a techie, originally a Unix kernel engineer, coming in from the outside. And so my view is that one of the benefits of doing this in India is that there's no legacy. How many of you have used Skype or something like that to talk to others, right? So the reality is that communications is, moving bits is nearly free. Moving money is nothing but moving bits. If moving voice bits can be free for most of us, why should moving money be costing us anything? And the reason it costs us something is because we have a legacy system, and those companies are vested in preserving that system. So in India, we don't have that legacy, so moving cash in India is free. So UPI is free for all low-value transactions, and therefore, as I think Prashant also mentioned, places which have such a system will become less cash economies faster than the traditional economies that we have right now.
Nothing wrong with free. Prashant, I have a question for you. We are starting to see a lot of these bigger tech companies, Facebook, Google, enabling users to send money through their platforms specifically. Obviously, there's also Square and Venmo. PayPal has an $88 billion market valuation as of the end of today. I'm curious how JP Morgan Chase views these kind of more legacy tech players. Are they partners? Are they competitors? How do you look at them in the current landscape?
Our view on platforms like the ones you mentioned, Leslie, has very much modernized and evolved. I mean, if you just look at what we've been saying in public press also, our mindset very much is to move away from built by JP Morgan to enabled by JP Morgan. So we partner with many of the institutions that you mentioned, and we would like our platforms to have ubiquity, because we believe ubiquity is quite important for relevance. So that's where we are going. But as a matter of comparison, and I can only share publicly available facts, I can tell you, and this is public, Zelle in the third quarter, which just finished, moved about $17.5 billion of cash. And Venmo in the third quarter moved about 8. So now, you may think Venmo is like this thing that everyone's using, and oh my God, Venmo is coming, and banks are dead. But the numbers are what they are. And we're also now, they're growing fast, and we're also growing. So I think we are in the second innings of the baseball game, and it's too early to call. And I just think it's going to be a fun next 4 or 5 years. It's just going to be amazing,
And do you think? Sorry.
How does that play out in terms of age? We were talking about legacy, and there's legacy in terms of systems and data. But what about age and generations? In terms of, let's say, for that example, Venmo versus Zelle, which I just used earlier today.
Great. Listen, I can only tell you so much. See, the thing is, Venmo is 9 years old. It's a 9-year-old child. Zelle is a 3-month-old baby. So, fine. So, I think that I would tell you that adulting millennials very much are on the Zelle kind of camp, because you have access to your money right away, it's safe, it's universal, and all that. But, Venmo is a great competitor, and it'd be a fun ride.
So I would say there's one very important thing. I agree there's a demographic angle for the short term, but there's one very important thing, which is when you're actually deeply connected into the banking infrastructure, you can deliver better user experiences than if you're an over-the-top player, which is essentially what Venmo is. So I had an experience. I was sending money to both my kids. I've used Venmo for a couple of years, been happy with it. The money was slightly more than normal. First transaction went through fine. Second transaction was declined, because from them, it was a risky transaction. Same transaction through Zelle, which was just launched, and it went fine because I'd authenticated to the bank, and so it was a bank. The bank had my money, and they were fine sending it. So there are differences. It looks, if you're selling up for a pizza, yeah, it's probably going to work fine either way. But when you start moving up the transaction value stack, being in the actual network of the banks is a powerful place to be.
Are there differences in security as well?
Yeah. I mean, the banks spend literally hundreds of millions of dollars. I mean, Prashant can talk to it better than I can, but I know they spend literally hundreds of millions of dollars ensuring that authentication to the bank is robust, because if not, then people are in there stealing money. So that's a non-optional investment for any bank. That's an existential risk. So yeah, if you're logging into the bank's property, then that's as good as you can get in sort of commercially regular terms. You know, it's not the nuclear codes, but you know, it's right up there.
Close to the nuclear codes. David, you mentioned kind of the generational difference, and I know that you focused a lot on investing and saving, and especially the millennial demographic. It seems like, you know, when you kind of survey the fintech landscape and you look at how technology has penetrated all parts of the finance universe, investing and saving seems to be more at the tip of the iceberg than having completely, you know, spread throughout the ranks. I mean, why do you think it's been so difficult to penetrate the saving and investing world, whereas, you know, when it comes to other areas of fintech, it seems to be much more pervasive?
Like payments, for example? Yeah. Well, I mean, investing is something that is, it's scary. It's, you know, it's complicated. You know, I think we've got this generation that probably didn't have parents who taught them how to invest, like, you know, my generation did. You know, it's been arguably made to seem complicated, so you have to pay people a lot to help you with it. And you know, what we looked at, we just took a fresh, you know, look at it and said, you know, why can't we make it like we were inspired by Weight Watchers? Like, how do you get someone to start investing? How do you get someone to lose 20 pounds? You know, you don't try to get them to, you know, to learn all about nutrition and lose 20 pounds. You maybe try to get them not to gain a pound, and then you take them on a journey and you start small. And that was the thing when we you know, as sophisticated, with all due respect, as these platforms are, there's something to be said for something that's lightweight and simple. And you know, we were laughed at early. People said, well, people are going to graduate. This is a toy. And you know, and I was around at the beginnings of social networks. It's my punchline, right? I started a social network in 1996. But in many examples of innovation, including the personal computer, the first, like, these early innovations look like a toy. You know, because otherwise they wouldn't fly under the radar of huge companies. And you can release a toy quickly, and it could be half broken, and the people that love it are happy to use it, even if it's half broken. And so you know, I think that comes into play, where something that's simple and lightweight and plays to the kind of expected user experience of a generation that doesn't know that usually it takes, you know, 20 pages of signatures and notarization to open a brokerage account. Like, they don't know that. They're buying stock at the bar on 9 o'clock at night. You know, and if they have a problem, they call customer service, and we have to be there at 9 o'clock on Saturday night. And it's like, it's Amazon to them. So it's a very different perspective.
Are you finding that that's something just very focused for millennials, or is that something that everybody's looking for? Is there something about the millennial demographic that type of platform is necessary, or is that something that you think baby boomers and beyond can also utilize much more of a simplified model and a technology-based model for investing?
Two things. I mean, I think that you know, that a millennial probably doesn't have that legacy of, you know, experience. You know, when I use Zelle, I tend to use it on my, you know, at work from my desktop. If I'm on the go, right or wrong, I'll probably use Venmo. So, you know, I think part of it is that expectation. The other part of it is just simply, if you're going to try to get people to innovate, to do something very, you know, new and different, it tends to be easier to start with people who are young. And I think they perceive risk differently, right? Like, if I said, I want you to link your bank account and give me your social security number and open a bank account, like, we were 3 days into launching Stash. Stash sounds like drugs, right? It like, nobody knew who we were. Nobody knew where this money was going, you know. And in 3 days, we had 5,000 people in 3 days link their bank accounts, give us their social security number, and like, why would they do that? We were surprised. And I think, one of the reasons is, and I'd show it to my investors and they'd say like, well, I'm not signing up for that. Someone's going to hack into my bank. But the average customer for us was like, what are they going to do? Take my $10? I have nothing to lose. And so it's a little bit of a different mindset and a little, I think, different perspective about risk.
Or maybe they were just looking for drugs.
Maybe. Sorry.
Sharad, I have a question for you about India and how we should look at the payment space and compare it to, obviously we have an infrastructure here that's been going on for decades. How would you describe that world in India, and what are some of the challenges and obstacles that you face that we may not appreciate here in the United States?
Yeah, so I think we had an opportunity to start with a clean sheet of paper, so we could do several things differently. So if you see, the first one is authentication. Instead of giving your social security number, in India you have a biometric kind of a system which works either with your fingerprint or your iris or SMS on your phone. So it's very straightforward to authenticate yourself. The second is that you can open an account very quickly as a result and very inexpensively. That system, which is called eKYC, electronic KYC, currently does about 15 million transactions a day. So there are 15 million people in Australia being added every day. And just to put that in perspective, the cumulative number of credit cards, active credit card users in India who use a credit card at least once a month is roughly about 16 million. So what credit card industry has done over 30 years, it gets added every day, literally, in India. So you have eKYC, then you have e-sign. So again, signatures are nothing but locking a document and being able to say who you are, because authentication allows you to establish who you are. You can sign, let's say, lending documents, saving documents electronically on your phone without needing an RSA token. So India, by December of next year, will be the largest user of digital signatures in the world using this system. Then if you keep going on, and that brings us to payments, you can now design a payment system which essentially makes an assumption that payments is a utility. It ought to be available at cost. And frankly, since moving bits costs nothing, it should be available for free for people who are doing low-value transactions. And that upends the market, because all the traditional businesses that relied on making a transaction fee, are going to go the same way as my past employer, AT&T, right? And and if I don't mean that in jest. I left the AT&T world after doing a startup. I sold a wireless infrastructure startup to Cisco here, not far from here, in Madison, New Jersey. And if somebody asked me in 2004, that AT&T would not be the largest carrier of paid international voice minutes 10 years from then, I would have fought with that person. But in 2009, that happened. And who replaced it? A small company out of a country I would not have been able to place on the map, Skype from Estonia, which was born only in August 2004. So in its first 5 years of existence, it displaced what Graham Bell had set up over 70 years. So I think that is the revolution that is happening, provided all the stack is replaced. And that is what has happened in India. And the numbers in India are very, very large. So if you look at authentications, there are 61 million authentications that happened yesterday, right? And they happen day after day after day. So there are 600 million people who are enabled on the new payment systems. And this is why you see Uber having launched this. They talked about it at the Money 2020 conference that took place recently, saying this is the most progressive payment system in the world. You have Google that's entered that system. WhatsApp or Facebook, the first place they launch payments is because of this system. Because the difference between Zelle or Venmo and this is the difference between the way we use email and the proprietary email. So the reason our emails reach each other is because there's a protocol called SMTP. And in this case, India has been able to establish an underlying protocol called UPI, and anybody and everybody can offer a payment system on top of that. But no matter whose payment system it is, it will interoperate with everybody else, right? And it's very secure. So So that's why it's a new stack that is developing, and that is going to unleash a credit cycle and stuff like that. We can talk about that if there's more time.
So when you said that biometric authentication, that replaces social security numbers and other forms of ID that we use in the United States to make sure that whoever is in charge of our transaction can confirm it's us. We saw a big breach of that recently with Equifax, where about 146 million Americans saw their private information, in the hands of someone they didn't want to have it. I'm curious, James or Prashant, how you view what happened at Equifax at your own companies and the importance of cybersecurity in protecting user information that we do still rely on today here in the United States.
Yeah, so it's obviously there was a very bad day for a number of people, and that company in particular. But I think really, if you take a step back, it is sort of emblematic of infrastructure that hasn't kept pace with the modern age. And so in India, they are essentially fast forwarding into the modern age, and in this country, we're not. There's a number of systems that have grown up over 40, 50, 60 years. Static data that essentially sits in a database, and protecting static data is incredibly hard. You can put all the kinds of firewalls, but you only have to be wrong once, and you're wrong forever. So as we've been working on payment stuff, which I'm obviously most familiar with, our whole strategy for the last 20 years has been to replace static data with dynamic data. So the whole EMV chip card and everything we've been doing over the last 20 years has been about adding dynamic data to a static payload. If you take your magstripe card, that's just static encoded data that somebody at IBM came up with in 1964. And if you take a chip card, the payload that comes off every chip card is unique, has something called a cryptogram. So that's how we've been investing over the last 20 years to make our system intrinsically more robust. So not just about putting firewalls up, we've got lots of those as well, but it's about making our data intrinsically non-useful if intercepted. It's been a 20-year journey, and billions of dollars has been spent on it across the whole ecosystem, and that's what it takes to upgrade, an old technology to a new technology without losing things like backwards compatibility, doing it in a way that's backwards compatible, so you don't lose all the benefit of scale that you've built up. So that's how we've been working on it at MasterCard.
I actually don't have anything else to add. I agree with James. Tokenization and dynamic tokens is the way of the future. I actually think that as we have this discussion tonight, and for those of you, for the folks who are students here at Stern, I also want to just see if we can keep up with the list of what we believe here on the panel. Sorry, Leslie, I'm just going to...
No, please.
Just as 20-year kind of secular trends where you guys can build a career around. So if we were saying to you around payments, what are the type of things that you should maybe think about where we see huge career opportunities, what would those be? So I would say, just to summarize our discussion so far, transformation of the customer experience, big deal. Because as things electronify, as payments gets embedded in a broader experience, there'll be careers around that topic. This notion of dynamic tokens and security, it's a big 10-year trend, 15-year trend. So I'd say this is another one where think about either if you're an investor or if you're looking for a career, those are great kind of forward-looking things. I also think that the third one, I see a real trend, which is in many industries, Sharad, if you look at medical devices, for example, or if you look at networking or mobile, companies from developed world have gone to developing world to innovate because they've found pods of, innovation often happens on the periphery of the network, and then it comes back into the core. So I also think that there is an interesting investment thesis or a career thesis for those of you to be focused on some of these edges of the world where things are actually transforming a lot more, and you can sort of bring that back into markets like US.
Listen to Prashant, because when I graduated from NYU Stern, I worked at a newspaper, so tech is probably the way to go.
No, can I just say that one of my big learnings in life is actually when you think about a career, or if you think about investing, roughly 90% of the outcome is driven by what spaces you choose. And 10% of kind of the outcome is driven by your performance. So I have to tell you, it's really important that you think hard about what industries, what companies do you go work at? Because, it's that 9 out of 10, that drives performance.
And may I add something to that? See, and the new phenomena, that many business schools haven't caught on to is that there is non-linear change happening. Clearly, we talked about the communication industry, which in the last 20 years changed more than it had changed in the last 50 years. That's happening to cars. It's happening to banking and payment industry in India. And so this is a phenomena where the rules of operating in that kind of an environment are very, very different. And since iSpirit is now a case study taught in 3 business schools here in the US, I can tell you, those 3 business schools don't get nonlinear change at all. So I think I would strongly encourage you to learn from the tech industry, because this is where nonlinear change is a fact of life. And that reality is coming everywhere else. And the first rule is, which is the rule of Linux, don't make grand plans. And I could spend a day telling you about all this, but I think things are changing fundamentally. As an individual, as a student, you've got hierarchical organizations won't matter, networks would, non-linear change would matter more than evolutionary change, and many other things like that. And so I would suggest that you take all this on board and rethink the traditional myths that are there about your career.
In a very polite way, Sharad is saying, I don't know what I'm talking about, because that 90% thing doesn't quite work anymore. It's not about some big plans.
Wasn't it your CEO who said the existential threat to your company is from Silicon Valley, right? Or something to that effect? Yeah. So I think, isn't that true? I think that is true, and therefore there is more to learn from them in terms of what's going to happen in the future.
Well, how about you, David? You've been a serial entrepreneur. What do you say about this world of, choosing between being the disruptor or the disruptee, and how to navigate that world as a future for your career?
I started my career off in a more traditional way. I went to Harvard Business School and worked in management consulting, and my dad worked for the same company for 40 years, from the mailroom to the board, and then after an LBO went sour, so did all these lifelong relationships, and it scarred me. And I think, that world of, okay, you went to Brown, you went to Harvard, you went to all the right places. Now you're going to go work at Goldman, and everything's going to be hunky dory, and you just keep working. I feel like that's broken, and I question. No offense, I went to business school, but I think about whether my kids will go to business school. They have 2 entrepreneurs as parents, and it's, there's risk and there's uncertainty, and what I do is crazy. You have to be crazy, I think, to be an entrepreneur. You do. I'm nuts. And once you do it, you can never go back. They sold my first company, to Microsoft, and after that, no one will hire me because they know I'll just leave. I'm unhireable, so there's not job security or any of that. I don't even pay myself, but I do.
How do you eat?
It's turning into a therapy session.
Mortgage.
Exits. But at the same time, I think, when I try to do this with my children, to question and challenge, and don't look at the world necessarily the way that it's been working, to think about things in short, small, quick experiments, side projects, and so, that's how I live my life. I spent, months and months after Stash just, observing and looking at the world and trying to figure out what to do next, and and failing fast. Like every week I'd come back with another idea, on a lean canvas, and my wife was like, "What are you doing? You're driving everyone crazy. I can't listen to your next idea, your next idea." And then one day I came home and I said, "I'm going to change savings," and then I said, "All right, I figured out what I'm going to do," and I locked and loaded. In 45 days, I'm going to go change the world of saving. And it's a thrill, and it's about speed and execution and surrounding yourself with the right people. And there is always the threat of failure, and there's a million things that can go wrong. But I think we need to keep this mentality of it's okay if you fail fast, if you make smart assumptions and you test them with data and move quickly. If I couldn't move quickly, these guys would crush me in a second, and maybe they will. But but ideally, I'll be nimble. I'll be right enough, and then I'll stomp on the accelerator.
One of the most controversial topics, I think, of 2017 is the idea of cryptocurrency. And we're seeing all these smart people coming out on both sides of this debate. So I would love to hear from each of you, perhaps starting with you, Sharad, about whether you think Bitcoin is the future of currency or whether you think it is a fraud.
You see, blockchain is a wonderful technology. I would say that.
That's my next question.
Yeah. Now, I think there are different modalities within which it will be used. In places like India, the role of that is to create social trust. And to create social trust, you need two things to fall in place. You need to be able to know who you're dealing with on the other side. Identity, therefore, is very important. And that's usually an established situation in the West, because in 1875, England said birth registration is compulsory. You can't leave the hospital without birth registration. And so therefore everybody's identity got established, from that point on. That hasn't been true in the developing world, right? Because many births don't take place in a hospital. So you needed a different system to be able to solve that. And India has solved that. The second part, of course, is the whole distributed ledger, right? Because that's the second part of this. The problem in places like India is that the transaction costs are still very high. They need to fall by a factor of 4 to be applicable in a place like India. So we are probably 5, 6, 7 years away. We're not 10 years away. And when that happens, I think it will lead to more social trust, and therefore, will lubricate business as we see it. I think the use case here in the West is completely different, right? Now, having said that, your specific question is about the currency. That looks like speculation to me, I must admit. But I am not an expert in that area, and so I would refrain from making any bold statements on that.
I am curious, though, because a lot of defenders of Bitcoin and some of the other cryptocurrencies say that there is a use case in the emerging markets. Do you agree with that?
There are two problems. One is the transaction cost. The second is the energy cost. I mean, the mining in a country, remember, the US has 5% of the population, 25% of the energy consumption. If India starts living the way US does, we'll be completely screwed as a planet, right? So, we have to figure out, as China and India, people come out of poverty, we have to have a completely different energy density for those people. And so this whole mining is an energy luxury that emerging markets cannot afford, because that alone is very expensive. So I think the concept is very good, and we will go through a number of generational changes before it becomes truly widespread in places like India.
What do you think, James? Fraud or future of currency?
Okay, so in a sense, every currency that's in circulation is a con game, in the sense of it's a confidence game, right? It depends, the value depends on the confidence of the institution or the thing standing behind it. So I remember in the financial crisis, they were talking about people queuing up there was this concerns about the monetary system, getting a bit shaky, and people were queuing up at ATMs to get real money in case their cards weren't going to work. And it sort of had one of these weird moments. It's like, so they're going to eat the real money for nutritional value? Because the money, the notes are only as valuable as somebody being willing to take them and giving you something useful like food, which you can survive on. And so you realize a dollar bill, I mean, if anybody's read *Sapiens*, and I'm just kind of getting into it.
I have. It's wonderful.
Yeah, but he talks, one of the main premises of his book is that Homo sapiens won because we were able to conceive of these great myths and all buy into them. And one of them he talks about is actually currency. It's basically a myth. And so I look at Bitcoin as just another scheme, and it depends on the confidence that people hold in it. Instead of in the Fed we trust, it's in math we trust, right? I mean, it's basically, can you break the crypto? So as long as people want to trade it and see value in it and willing to believe in the intrinsic kind of underlying math, it's going to be useful for certain use cases. It does have some structural problems, which is how you establish the kind of the limited pool is incredibly energy intensive. I mean, I think every Bitcoin transaction consumes the same amount of money as like a household of 3 people or something for a week, or some crazy numbers out there floating around because of the mining and there's all kinds of bad behavior that results from that in terms of where mining takes place. So the current instantiation doesn't look completely scalable and sustainable, but if it works for people, it's gonna survive.
I think back to our discussion 5 minutes back about incrementality and thinking of change as a series of things that ultimately take us to a different endpoint. I think what's interesting about this is that it's a start of something different, and the underlying plumbing is actually very interesting. So I know this is going to be our next topic for us, but I think the underlying plumbing of blockchains and how you have smart contracts is, I think, quite disruptive. It can disrupt industries like insurance, where frankly people can actually crowdsource and have trust-based contracts and people can pay each other. I mean, there are many, many use cases that are genuinely NPV positive type of things. So I think that's the more interesting news, as opposed to, I'm not quite sure how long this will sustain. It feels like a bubble. But again, I think the more interesting thing is if I was in this room, I'd study the underlying foundation of what's driving it.
Yeah, I mean, I don't have nearly the expertise of this group, but I do agree that, you know, when the time for to me, the big opportunity for entrepreneurship is when things start to shake up, and there's uncertainty, and you know, that's when I think, you know, the nimble have an advantage, and you know, there's always going to be a lot of failures along the way, but I think it's exciting. Just as a field, after savings, I'll go check it out.
I think we may have time for 1 or 2 questions. If you all have a question, there are 2 mics on either side of the aisle there. Feel free to step up and go for it.
He's my student, so we're double teaming here.
Age before beauty, or?
Hi, how's it going? So FinTech, we've been seeing it the past couple of years, has basically been unbundling a lot of the services that typical financial institutions provide, like the banks. But now we're seeing, you know, like JP Chase offers quick pay. I use that basically every day. And I guess my question is, what happens when these institutions start adopting all these new things and rebundle them under their services? They'd have, you know, the same people have the same power, offer the same things. Where does these smaller companies, where do they lie? So my question is I don't know.
For Sean?
Yes. Do you think that these institutions have the ability to, I guess, integrate these new products into their current infrastructure?
Very much so. Your next speaker will talk about the infrastructure that Amazon is creating, and I mean, I'll not steal your thunder. I mean, you know, I think the whole premise of APIs and what's happening through it reduces the cost of integration and friction significantly. So if you just Google search what JP Morgan has done, we are now working more and more with pure play fintechs, and we are integrating them into our broader proposition, much more so than we've ever done in the past. So, I mean, if that's your narrow question, then that's the response, which is we assess the ecosystem quite diligently, and we are not the only institution. Most large banks now and more are actively looking to work with the ecosystem and integrate the propositions in a way that creates customer value.
So, I mean, another angle on this also is, well, first off, it's culturally not that easy to do that, though. With it's because institutions like repeating what they've done that's made them successful, and change is hard in large, successful institutions. So that's kind of a challenge that, as somebody who works in a large company, faces every day, is kind of changing that culture and that mentality to embrace things that have come from the outside and kind of open up to it. There's also some challenges around kind of the regulatory framework that says, there's a certain set of expectations around what being a bank is, for example, that you have to live up to. So it can be done, but I would say it's not a layup, unless you want to contradict me.
Yeah, I think you're absolutely right. One way to think about, you use the word unbundling. In a sense, a bank is identity, payments, savings, credit, all bundled together. And in places where the regulators have been supportive, like in India, they have systematically unbundled all this, right? And now new bundles will emerge, and inevitably that will lead to new players. I would encourage you to watch this absolutely fascinating presentation by Clayton Christensen. He says, I wake up in the morning and I don't know who to pray for. Should I pray for my theory to be right, or should I pray for my institution? Both have been really nice to me. Because he says, what's a business school? Business school is great teaching, is credentialing, the label that you get, and alumni. And all this is getting unbundled. And in the tech industry, your academic credentials don't matter at all. It's your achievement credentials, right? You can do well in Google Code or Kaggle. That probably is more valuable than any kind of credentials that you get. And if you really want to learn about AI, you can learn it free from Peter Norvig on his Udacity course. You don't need to go to Stanford to do that. And if you're really looking for alumni networks, there are many other alumni networks. For example, YPO has a resurgence because of social media here in the US. And so you could make an argument that a higher education institution is up for disruption the same way the banks are. Both don't know this is happening to them. They'll know that only 10 years from now.
The other thing that always sort of got to think about is kind of a microeconomics, because fintech has attracted a lot of venture capital, but at some point in time, the venture capital needs to get a return. And cost of customer acquisition is a big part of any of these kind of growth companies. So that's one of the opportunities for kind of bundling or rebundling, is that you're able to share the cost of customer acquisition over a whole bunch of services. And pretty much everybody has a banking relationship who's got money. So that's the other counterpoint, which is that the microeconomics do come to bear at some point in time and can cause that, as long as you can deal with the cultural change.
I'm gonna disagree respectfully, and I can't divulge too much, but let's just say that in my experience, I've seen acquiring millions of customers, getting them to do things like link their bank accounts, and I won't say it's by my company, but my cohort of companies in like a $10 acquisition range, which I don't know, but I would imagine, based on valuation and benchmarks, that's orders of magnitude lower. And I think one of the reasons is because we're able to reimagine the experience and challenge the assumptions about the way things work and what success means to a customer.
But ironically, your service wouldn't have existed unless the banks existed, based on your own explanation. You had to link a bank account, so it's sort of like you were sort of piggybacking on the bank account's existence.
Great, thank you. I mean, I'm not.
But what's to stop them essentially emulating your service and bundling it back up? That's the question, right?
In my view, what's to stop it is so. I've been talking to some of the folks at Goldman Sachs, and they're building a robo investment arm, and I said to them, how are you doing this? And again, I don't mean to be disrespectful, but they said, well, we got a team of 25 people. Everyone here has worked at Goldman for their entire career, and obviously super smart, talented people, and like they're all VPs of blah blah blah, and and we're starting with like 25 million bucks, and I just said, okay. I mean I've never done anything like that, but in my experience, and I'll be humble there, of like, if you can't throw something against the wall fast and see if it breaks and test it and be willing to fail and start small and be nimble, like, to me that's kind of it's like the way, it's the to the Dow, it's running lean, and I can't imagine starting a startup with those kind of things going on, even just the politics and the fear of making a mistake. And I've never done it, and so I can't really speak to it, but it seems hard to me.
All right, we'll take that one question over there.
Okay, thank you. I'm not a millennial, so I am worried about my assets. You mentioned the EMV card, the chip card. In this country, we're still using chip and signature and not chip and pin like they do elsewhere. Why are we still using chip and signature? And just to follow up on it a little bit, I saw your eyes go to the ceiling.
Yeah,
Very embarrassed.
It's a popular question, yeah.
And let me ask the second question. I love my Apple Pay. It uses a cryptogram, it uses a token, I've got a biometric. When you talked about Zelle does not disclose how they protect the transaction while it's in the air and when it's being transmitted. Do you want to talk a little bit about how they protect their transactions? Why don't you take the first one?
Okay, so chip cards. Okay, so yeah, every chip card generates unique data. We have two modes that it can operate in, which is chip and pin and chip and sig. So the signature basically doesn't incorporate the unique aspect of having what we call cardholder verification method, i.e. a pin in most of the world. Actually, in many countries of the world, it operates without PIN. In fact, it launched in the UK originally, and it launched without PIN. It was chip and signature, and then at some point in time, the government basically said we want to move to chip and signature, and chip and PIN, and that's also been true across most of Europe, but not across the whole world. It's actually a classic challenge of any kind of system that's already moving. How do you upgrade it as you go? So we got everybody to agree to move to chip instead of magstripe because there was a real challenge there. But a number of the banks, when we talked about chip and PIN, they were worried that unless everybody went, then they would be at a competitive disadvantage because they believed that customers would go to the most convenient solution, and they perceived that to be signature. And so you end up with sort of interesting situations. Essentially, it's kind of a prisoner's dilemma, which is unless you can get everybody to move, nobody wants to move.
But they all use chip and PIN when they use debit cards. So they're already using it for a huge number of their transactions, or maybe the majority of their transactions.
Yeah, so this is a bank question, so I'm going to refer to my colleague on the right, because I'm relaying what I heard from banks.
You know what? I'll just go to in the interest of time, I'll go to your second question about Zelle.
That is masterful punting, gentlemen.
Spoken like a true former consultant. Choose your questions.
No. Listen, in a public forum, we should pick the discussion topics. I mean, listen, Zelle is powered by EWS, Early Warning Services. If you look up kind of their genesis, they are a platform that was built around fraud protection for banks. All the customers who enroll in Zelle are by invitation, are part of you can only be part of Zelle if you are part of any bank or debit card. And so think of Zelle as a closed loop network of authenticated endpoints. And so the folks at EWS do a great job of running all kinds of machine learning based fraud detection systems.
But you haven't answered the question of how do they send the transaction. Is it a cryptogram? Is it a token? Is it encrypted? How do you get the data in a secure form to be processed?
It is sent as a cryptogram.
Okay.
Yeah.
Thank you.
Okay, I think we have time for one more question with a quick...
I promise I'll make it quick. So my question is for you, Sharad. We normally think of developing countries and we think of lack of transparency, right? UPI sounds like India's breaking the mold. What all other initiatives are happening to bring in more transparency in the system? And also, following up on that, what do you see as a big scope or opportunity right now in India?
You know, one thing that the US used to do very well, but I think in recent years has lost its way, is that it used to build public goods on which private wealth creation used to take place. So for example, you'll agree with me that if there was no DARPA, there would be no Cisco. If there was no Stanford research, there'll be no Google. If there was no GPS, there would be no Uber. And if there was no Linux, there would be no Red Hat, right? Now, remember, in the Valley, all this private wealth creation took place on the back of public goods. Some of those public goods were publicly funded, like DARPA and GPS, but the others were not. Stanford University research was not, and Linux, of course, was a volunteer effort. So the question, I think, what US had was a unique model of this interaction between public goods and private wealth creation. So when Uber came along, you know, it used the smartphone, the Google Maps, and GPS. None of them had been built for Uber. They just applied combinatorial innovation on top of that and started changing the transportation industry. And that's what David was talking about earlier, right? When you recombine stuff in a way, you know, which small teams can do big things. Now, what has happened in India in the last 8 years is a group of techies, you know, they're all iSpirit volunteers, decided to build this stuff, you know, as volunteers. So our mantra is build public goods without public money. Because in India, taking public money has enormous consequences, right? It leads to corruption. So the only way to do that was as volunteers. And so that's systematically built this stack that I talked to you about. And I think that is unfinished business. There is more to be done. But what it is doing is bringing stuff into the digital world. And as it brings stuff into the digital world, it necessarily offers more transparency, provided the regulators are willing to go along. And I think regulation is a very, very important part of this. I think, you know, we have the same problem in India that we have here in the US, that the incumbents capture the regulators. Until such time the banks capture the regulators, they will never allow a disruption to happen. The same thing happened, I was here in the US during the mid-90s telecom, so long competitive, you know, local exchange carriers, which were kind of sabotaged by the incumbents. So you need regulators who are going to support the challenges. Now, luckily in places like India, the regulators don't know the right hand from the left hand. So by the time they figure out, you know, so therefore non-linear change is agility is very important. And when you're operating in a volunteer mode, they don't even know who you are, you know, because they're so confused, right? How could this amorphous group of people bring something out? So these are these techniques that you have to use to get things done, and they seem to be working in a place like India. And now, you know, hopefully we can build on it and bring all these digital transactions. The big one in India is actually the tax. There is a big change in tax system that has happened. I won't go into the details. It's called GST, but it essentially mimics a little bit of the blockchain idea that we talked about, where the onus of making sure that the tax has been paid by the supplier is actually on the buyer. You know, there isn't a third entity called the government which is supposed to enforce that. And it, you know, I could talk at length about this, but these are some of the innovations that are happening on the back of essentially volunteer work and you know, in a non-profit kind of a setting. So I'll stop at the last pitch that I want to make. In this non-linear network-oriented world that we are going to be in, the best training ground for you is to actually work for a volunteer open source project. If you're a software guy, what you can learn by working for Linux is much more than you will learn by going to any college. And same would be the case for almost anything that you're talking about, because this free public goods that you are able to create in that model is going to ultimately power all the private value creation. And so it gives you a ground level view of what's going to happen in the next 5-10 years.
All right, Sharad, James, Shant, and David, thank you guys so much. Unfortunately, this is the end of the time that we have here, but appreciate your insights and good stuff.
Thank you so much.